Hello, this is Tim Congdon, Chairman of the Institute of International Monetary Research at the University of Buckingham. This is the latest monthly video. I'm not on this occasion going to update you on global monetary trends, although there is at the moment a very interesting debate about whether the money slowdown justifies forecasts of a wider slowdown in the growth of demand and output, and indeed therefore whether central banks should be raising interest rates. I'll return to that next month. This time I want to talk about a lecture given last year by Sir Charles Bean, who's been chief economist at the Bank of England. It's called the Wincott Lecture. I've just written a criticism of that. It's appeared in the Journal of Economic Affairs, and you can look it up there. But I want in the next few minutes just to explain the main points of my criticism, because they bear in a very fundamental way both an understanding why the Great Recession occurred about a decade ago, and also about how policy should have responded to it and how policy should evolve from here. Now, Charles Bean is a very distinguished economist, and I don't want to be too sharp in my criticisms, but I have to tell you at the outset that I disagree almost totally with what he said in the Wincott Lecture. And it seems to me what he said was just totally misguided and wrong-headed. He wanted to explain, above all, why interest rates have been so low since 2008. We've had essentially a decade now of practically zero returns on bank deposits. A fundamental question is that long period of very low interest rates, which savers basically got nothing at all, was that due to policymakers' mistakes, including possibly mistakes by the Bank of England, or was it due to something else? Now, what Charles Bean claims in his lecture is that the main cause of this period of very low interest rates has got nothing to do with monetary policy, and it's driven by what he calls real underlying forces in the world economy. Let me be a little bit more specific about what he's going to argue. He says that criticisms from politicians and commentators that policies are penalizing savers miss the point that over the last 20 years, ultimately, interest rates reflect underlying real forces, things like the rate of return on capital, how much people want to save, and so on. Real forces in the world economy that central bankers are powerless to change. Okay, so this isn't the fault of central bankers. What he does is to introduce a notion of the so-called natural rate of interest, which goes back to the Swedish economist Knut Wicksell, who distinguished between the money rate of interest, it's actually paid in the bond market and bank deposits and so on, and the natural rate, which reflects, again, these underlying forces like the return on capital, how much people want to save, etc. And in this analysis, Charles Bean refers in particular to the importance of savings behaviour as an influence on interest rates, international savings behaviour, and then to demographics as an influence on savings behaviour. The idea being that, well, young people don't save very much, and that of course old people also don't save very much because they can't take it with them, so they run down their savings in old age. But then if there are a lot of people in the middle cohorts, in the late 30s, 40s, 50s, perhaps even their 60s, for a lot of people there, there'll be more saving, and that'll reduce interest rates. Sounds very plausible. However, you'd have thought that for Britain, it would be our savings market, our demographics that really matter. And according to Charles Bean, that's not so. What really matters apparently is Asian demographics, particularly Chinese demographics. And he said that, following, by the way, Ben Bernanke, that the demographics is very important, and in particular, China's demographic structure, age composition, the difference in the population shares of the middle and old age cohorts in China has been critical to low interest rates around the world, including base rates, bank rate in the United Kingdom, the deposit rates available to British savers. Think about that for a bit. This lecture wasn't given on the 1st of April. He's claiming, that the chief economist, former chief economist banker, is claiming that what goes on in China, the balance between different age groups in China affects what people get in British bank deposits? I put it to you, this is rubbish. And what I want to do in the next few minutes is explain why it's rubbish. And indeed, I'm afraid the bank is very much to blame for what's happened in the last decade. Let us look, first of all, very simply at a chart of UK bank rate over the period 1993 to 2017. You can see that in the first half of that period, bank rate is fairly steady, jumped down a bit, but around about, say, 5%, 5-6%. Okay. Then there's this plunge in the middle. It's basically nothing, 0.5%, from 2008. Now look, we've just had a claim in this Wincott Lecture that it's 20-year forces acting over 20 years that explain the low level of interest rates. No, I can tell you that fall happened in about the grand total of 4 months. Why did it fall? The reason it fell was that financial markets were in chaos. People worried about banks going bust, rightly or wrongly. There were forecasts of an intensifying recession, turned out to be correct, and the central banks had to react very quickly by slashing interest rates. You can look at the Bank of England's quarterly bulletin at that time, and in the discussion of these events, there is no reference to demographics, and certainly not to Chinese demographics, and certainly not to the age composition of the Chinese population. Though the reason interest rates fell in that period was market instability, financial market instability, financial market chaos, to be frank. Now this then raises the question of, well, if you then say that, things got better and since early 2009 the stock market's recovered and it's been a fairly stable decade or so since then. Got over the recession in late 2009 and okay. But base rate has stayed at almost nothing. Bank rate has been at 0.5% for a decade. Why? Why haven't we got back to the 5 or 6% that was normal until 2007, 2008? Well, I want now to refer to a speech given by the chap who for a time was Charles Bean's boss, that's Mervyn King, Lord King of Lothbury, as he now is. He gave a speech in Cardiff on the 23rd of October 2012, where he talked a lot about the British banking system. And what he said was that the trouble, what had really gone wrong, was that the banks, his phrase, we had a damaged banking system. Normally the banks grow their businesses by making new loans. That creates new bank deposits, new money. And if the pace of growth of the amount of money is in line with, say, 4 or 5% growth of normal GDP, consistent with the inflation target, consistent with macroeconomic stability, and so on. But the problem was, according to Mervyn King, that the banking system was damaged, and therefore it hadn't got the ability to create money, and therefore it was necessary to have such things as quantitative easing, but also very, very low interest rates. Now, it's clear from what Mervyn King was saying in that speech in 2012 that in his view, something had happened to the banking system which had damaged it so it couldn't create money in the normal way. A rather different kind of thesis from Charles Bean's in the Wincott Lecture. Let's look at a chart now of the rate of growth of bank lending to the private sector in Britain going back to the early 2000s. You can see that there's a period, again, rapid growth of bank credit, typically actually about 10-15% a year, up to, well, this kind of period, difficult period, 2007, 2008, and then for some years after the fourth quarter of 2008, bank lending actually fell a little bit, the stock of lending actually dropped, even though the bank rate, base rates and so on, were only 0.5% at that time. So yes, it's clear enough, in some sense, the banking system had been damaged. But how had it been damaged? Why wasn't it creating credit? What Mervyn King would like you to believe is that the banks had lost so much of their capital in bad loans, bad decisions, disastrous assets and so on, that's why they couldn't grow. I put it to you, the real reason they couldn't grow was very different. It's that officialdom required the banks to have much more capital to run their businesses. Essentially what Mervyn King and other policymakers did in late 2008 was to demand that banks should operate with about 70% more capital for every unit of risk assets than before. And that's what stopped the banks growing. You see, the truth is, the banking system had much more capital in 2012 when Mervyn King was talking than it had 5 years earlier. It wasn't lack of capital that was causing the problem, it was the demands that the banks have more capital relative to their assets, which stopped the assets growing, that stopped the quantity of money growing, which then led to the requirement for quantitative easing and very, very low interest rates. Who was to blame for this fiasco? Well, of course, everyone wants to blame the bankers. I would say the bankers weren't blameless, but I'd say, in fact, the key culprits for the demands for extra banking system capital were policymakers, including Mervyn King, including Charles Bean. Okay. You then get this question of, is it possible that Asian demographics can explain very low interest rates in the United Kingdom? In particular, is the Chinese savings glut, Chinese savings pool, can that possibly explain what happens in the United Kingdom? And other countries too, like the United States and so on, because some people even say that Chinese savings behavior affects American interest rates. Well, let me put it to you that there is a prior condition for that to happen, and that is that Chinese savings behavior affects interest rates in China. It's pretty implausible it's going to affect interest rates in our country or America or Germany or whatever. It doesn't affect interest rates in China. Let's look at this chart here. This is a chart of the Chinese central bank's discount rate, their bank rate. That's the lower line. And then there's what's called a lending rate, a bank lending rate, which is reported to the International Monetary Fund, and I've just used the IMS figures. I put it to you that actually, well, interest rates did come down in China in 2008, 2009. They went cyber and they went up again. And they didn't go to zero. What about Asia more generally? Well, Asia's got lots of countries. And many of them are very dynamic. Many of them have got lots of young people. Many of them have got a lot of investment because there's all sorts of things for young people and the middle-aged people to do. And they haven't many old people. Okay, I concede that's true. But, really, if what's happening there is to affect what's happening in Britain, we need to see interest rates there coming down to affect us, yeah? And this shows you the average of the interest rates of 5 Asian countries, China, India, Indonesia, Malaysia, and Vietnam. All quite big countries. Vietnam has a huge population. This is the lending rate reported to the IMF. Asia is supposed to have a savings glut that pushes interest rates down. Can you see it? I can't. On the contrary, yes, interest rates fell a little bit in 2008, then went sideways, then went up. On average, they're about 10%. Let's look at each of these countries individually. You see, in some countries, interest rates are 15, 20%, not zero. Look, in all seriousness, how can an Asian savings glut or Chinese demographics affect interest rates in Britain? Particularly when this is the actual picture of what those interest rates were. Well, look, you'll gather that I don't have much time for the main thesis of Sir Charles Bean's 27th Wincott Lecture. I'd recommend that you read both Sir Charles's lecture and my criticism of it. Of course, I want you to read my criticism of it. I think the wider message I want to get over is that British economics is in a terrible mess. And the notion that a senior policymaker can put forward such a totally implausible hypothesis to explain such a fundamental event is really quite terrifying. I will repeat what I've said many times before because I have no doubt this is the guts of the matter. The reason that the relatively mild downturn up until the summer of 2008 became the Great Recession of late 2008 and early 2009 was because of bank recapitalization. It was because of the move to macroprudential regulation, all this kind of stuff. That's what caused the bank to shrink their businesses. That's what caused the collapse in money growth. That's what caused the Great Recession. Thank you very much.